Shipping through the Strait of Hormuz has been at a standstill for several days. Bloomberg's Hormuz tracker shows that in the past 24 hours, only vessels linked to Iran have been moving alone through this global energy artery. Iran's Islamic Revolutionary Guard commander Jabari laid down a harsh warning. We will not allow a single drop of oil to leave this region. The Strait of Hormuz is closed, and any ship attempting to pass will be destroyed. This order splits the global energy map in two. In Asia, it's a gut punch. The oil lifeline is cut, refineries face shortages, and countries are scrambling to activate emergency plans. In Europe, it's a belated nightmare just as they were starting to recover from the energy crisis sparked by the Russia-Ukraine conflict. They now face a new supply gap, which could even make them rethink their ties with Russia. Asia is the biggest buyer of oil passing through the Strait of Hormuz. Of the roughly 20 million barrels of crude that flow through the strait each day, more than 80% are headed for Asian markets. China, India, Japan, and South Korea, some of the world's most important manufacturing and consumer economies, all rely on this waterway to deliver the lifeblood of industry. About 40% of China's imports pass through the Strait of Hormuz, which is roughly 5 to 6 million barrels a day. China is the world's largest oil importer. In 2025, it imported around 578 million tons of crude, with an external dependency of 74%. What does this mean? If the strait remains blocked, China could face a supply risk equivalent to 1/3 of its daily consumption. But it's not without preparation. By the end of 2025, China's strategic oil reserves plus commercial stockpiles totaled around 1.3 to 1.6 billion barrels, enough to cover roughly 130 days of consumption, well above the International Energy Agency's 90-day safety benchmark. Kepler data shows that by the end of February, China had 7.6 million tons of liquefied natural gas in storage, offering a short-term buffer. But analysts warn that if the blockade continues, Beijing could be forced to compete with Europe for Atlantic LNG shipments, tightening supply across the Pacific and driving up prices throughout Asia. On the 3rd of March, during a routine press briefing, Chinese Foreign Ministry spokesperson Mao Ning sent a pointed message. Energy security is critical for the global economy, and all parties have a responsibility to ensure stable and uninterrupted energy supplies. India's situation is even trickier. The country consumes around 5.7 to 5.8 million barrels of crude per day, with 90% coming from imports. About half of that imported oil, roughly 2.5 to 2.7 million barrels a day, passes through the Strait of Hormuz. The challenge doesn't stop there. India heavily relies on Gulf suppliers for liquefied petroleum, gas LPG from the UAE, Qatar, Saudi Arabia, and Kuwait, all of which must pass through Hormuz to reach India. The Indian government is weighing a range of emergency measures, including limiting fuel exports and increasing crude imports from Russia. For India, this means making a tough choice between Western pressure and ensuring energy security. About 90% of Japan's oil imports pass through the Strait of Hormuz, while for South Korea, the figure is around 70%. For these two countries, which have almost no domestic oil or gas resources, Hormuz is truly an energy lifeline. By the end of December 2025, Japan had stockpiles equivalent to 250 days of oil consumption, so short-term supply isn't a concern. But the surge in oil prices is already putting pressure on inflation. Japanese Prime Minister Sanae Takaichi told the Lower House Budget Committee, "We will do everything we can to ensure Japan's energy supply remains stable." South Korea's emergency response is even more urgent. On the 2nd of March, the government and shipping industry activated an emergency response system. Over 30 South Korean flag vessels are currently navigating the Strait of Hormuz or nearby waters. The government has instructed these ships to move to safe zones and is considering unloading cargo at alternative ports. By the end of last year, South Korea's reserves could cover more than 210 days of consumption. South Asia is facing more than just rising oil prices. It's staring at the real risk of energy shortages. Pakistan imports 99% of its liquefied natural gas LNG from Qatar and the UAE. Bangladesh gets 72% that way, and India relies on imports for 53% of its LNG. These countries have limited storage and little flexibility in sourcing. According to the Institute of Energy Economics and Financial Analysis, Bangladesh already faces a structural gas shortfall of over 1.3 billion cubic feet per day. Plur's chief insight analyst Go Katayama summed it up bluntly. Pakistan and Bangladesh have limited storage and procurement flexibility. This means any supply disruption is likely to hit the power sector's demand directly, rather than just trigger aggressive spot market bidding. If Asia is facing a gut punch, Europe is dealing with old wounds reopening. After the 2022 Russia-Ukraine conflict, Europe spent nearly 4 years struggling to reduce its dependence on Russian energy, shifting to supplies from the US, Norway, and Africa. Now, the blockade of the Strait of Hormuz has Europe once again teetering on the edge of an energy shortage. Liva Zorjanfrija, chief economist at Swedbank in Latvia, issued a blunt warning. The Middle East conflict will push fuel and gas prices across Europe higher, driving inflation above previous expectations. She noted that in the worst-case scenario, Brent crude could break $100 per barrel, while gas prices might double. For Europe, such a price shock would hit household spending and business costs directly, and ripple through prices of other goods and services. In absolute terms, Europe's direct dependence on the Strait of Hormuz is lower than Asia's. About 900,000 to 1 million barrels a day pass through the strait. But Europe's problem is that it has no real backup options. Gunnar Kodzi, a professor of macroeconomics at the University of St. Gallen, put it plainly, the countries hit hardest are those heavily reliant on Gulf oil imports. Europe, having partially diversified to US, Norwegian, and African supplies, can ease the impact. However, easing doesn't mean immune. Norway and Africa have limited capacity and can't fully fill the Middle East gap. The US, while now the world's largest LNG exporter, also faces capacity constraints. Europe's diversification strategy has shown its limits in this new crisis. The blockade of the Strait of Hormuz is casting another big shadow over European politics. Russia. European policymakers worry that if Hormuz remains closed for a long time, they may have to rethink their stance on restoring energy ties with Russia. One report noted, Europeans fear that a prolonged Gulf closure could force the region to reconsider its tough position on resuming energy relations with Moscow. This is a highly explosive geopolitical signal. Since 2022, Europe has been willing to bear huge costs to decouple from Russian energy. But if the Strait of Hormuz remains blocked, Europe could be forced to make a new choice between relying on the Middle East and reopening ties with Russia. Russia has long been ready for this shift. Moscow has repeatedly warned that the West's refusal to buy Russian energy was a serious mistake, and high prices will create a new, even deeper dependence. Russia says that countries refusing direct purchases will still buy its coal, oil, and gas through intermediaries at higher prices. Alex Talavera, a professor of financial economics at the University of Birmingham, told the media bluntly Russia is very likely to benefit from this conflict. Shares of Russian oil companies began surging after markets opened on the 2nd of March, including Gazprom Neft, Lukoil, and Rosneft. Back in 2022, the surge in energy prices following the Russia-Ukraine conflict pushed inflation in Europe to historic highs. Now, that scenario could be repeating itself. According to estimates from Capital Economics, if international oil prices hit $100 a barrel, global average inflation could rise by 0.6 to 0.7 percentage points. For Europe, this means inflation, which had just started to ease, could climb again, forcing the European Central Bank to halt rate cuts or even restart hikes. The Oxford Economics Research Institute estimated in June 2025 that if crude oil hits $115 a barrel, inflation in the Eurozone could rise to 3.5%. That's well above the European Central Bank's 2% target. Several institutions have outlined scenarios for how the current conflict might unfold. Diplomatic intervention, shipping is briefly disrupted but then resumes. This is the most optimistic scenario. Oil prices could briefly hit $100 a barrel, but would fall back as supplies normalize. Prolonged disruption of commercial shipping. The situation fluctuates between low and high-intensity conflict. In this scenario, countries like Iraq and Kuwait would be forced to cut production, potentially reducing global supply by 3 to 6 million barrels per day. Oil prices would stay above $100 a barrel, keeping inflationary pressure high worldwide. Major escalation. The Strait of Hormuz faces severe and potentially irreversible shipping disruptions. In this worst-case scenario, the global oil market could see a net supply shock of 7 to 10 million barrels per day. Oil prices might surge past $120 a barrel or even higher, putting the global economy at risk of recession. If the Strait of Hormuz remains closed for weeks or even months, with most tankers unable to pass, the resulting energy supply disruptions, persistently high inflation, and shrinking consumer spending could trigger a global economic recession. The surface of the Strait of Hormuz may one day return to calm, but the shifts this crisis has exposed will echo for a long time. For Asia, it's a stark wake-up call on energy security. China, India, Japan, and South Korea, some of the world's most important manufacturing engines, all rely on the same fragile maritime corridor to deliver fuel. This crisis is set to accelerate investments in strategic reserves, supply diversification, and energy transition across the region. For Europe, it's a geopolitical nightmare revisited. Just as they were emerging from dependence on Russia, they are now grappling with anxiety over the Middle East. Even more perilous, Russia is lurking on the sidelines, waiting to see if Europe will compromise in the face of energy shortages. The story of the Strait of Hormuz shows us one thing in the world of energy. There is no true independence, only fragile interdependence. A waterway just over 30 kilometers wide can simultaneously tug on the nerves of Beijing, Tokyo, New Delhi, and Berlin, sending tremors through every gear of the global economy. When this global maritime lifeline is cut, we see two different fates: direct impact for Asia, indirect pain for Europe. Yet both point to the same conclusion. Energy security is not just a national issue. It's a challenge the world must face together.